Hey everybody, it's John King, and it is Friday the 22nd of July. Here I am with my weekly market updates. So it has been continuing to be wild times with interest rates. This week it's good news. So the last couple of days we've seen interest rates come down, specifically yesterday and today. I'm not going to go into the complicated reasons why, other than simply saying, look, we are heading closer and closer to a recession. And it looks like we've hit kind of the peak of interest rates. Now, things can change significantly, but from what I'm seeing, from what I'm hearing, there's a case to be made that we've kind of seen the peak of interest rates when it comes to inflation and what's been driving interest rates up recently, that we're now at the point where we're really looking at interest rates being more stable. And it's the first time we've seen stability in a long time. So I want to kind of show you a chart really quick and give you a feel for that. So what we're going to look at is we're going to look at the chart of the 10-year Treasury bond. And treasuries are not exact mortgage rate comparison, but they move in similar directions. And I want to show you what that looks like. So what you're seeing right here is Treasury rates going back to February of this year. And we were down to 1.8% in February, and we saw rates go up and come down a little bit. But the point is they've been moving up and up and up, and they continue to move up and up and up. And we kind of saw a trend here of interest rates moving up. And let's see if I can draw another line while we are looking at this. So basically, you've got a line of interest rates that have continued to move up right here. And this is through June 14th. So this date right here is June 14th. And so we kind of saw that since February through June, we've seen interest rates continuing to move up. But now we look at where we're at, and they're kind of moving down a little bit. And when we look at the downward movement, it's just over the last month that this trend has been moving down. And I'm going to be super cool and see if I can draw another line and say what we've been kind of seeing here is interest rates that have been moving in the downward direction. And that's the first time that we've actually seen, we saw a little bit of a movement down here. And so you got to be careful, because this movement that we saw right here in May down to June was kind of a fake, and they didn't stay low. But the truth is, we don't know if this is a fake or not, but May and June, the May inflation report that came out in June. That's what caused that big spike in interest rates. And it's because we didn't feel, the industry, the markets didn't feel that the Fed was going to do enough to tame inflation. And yet in July, just a week and a half ago, we got an inflation report even greater than what we had from June's report. And yet rates have gone down. And the reason why is because it's actually kind of started to tip the scales that says, hey, the Fed's being super aggressive, and it's clear they're going to keep raising interest rates to combat inflation. But what that means is that we're even more likely headed for a recession. And that's the challenge that we're dealing with, is we're now going to be in a recessionary environment where people are going to start losing jobs. And we're going to start seeing more and more layoffs. I'm already starting to see it. Clearly, the mortgage industry is dealing with it, but a lot of other industries are starting to go down that road. And that's going to lead in general to lower interest rates. So the thing I want you paying attention to is helping to remind people that you know, or that you love, or that you're working with professionally, now is the best time for people who have a home to sell that need to buy another home, or people that have a minimal amount of down payment. Sellers are willing to negotiate, and I have not seen sellers' willingness to negotiate anywhere near as much in the last 5 years as what we're dealing with right now. We've had a huge shift in demand, and that shift in demand has caused sellers to get a little bit more desperate. Now, do I think that's going to lead to a foreclosure crisis? I don't. The reason why I don't think it's going to lead to a foreclosure crisis is because the demand is going to come back as interest rates start leveling off and potentially going down. And we're seeing those interest rates leveling off. Now, we've got buyers that are afraid, hey, I don't want to buy right now because I don't want to buy at before rates or prices go down. But I think that if prices keep going down, it's because interest rates are going to keep going up. If interest rates come down, prices are going to go up. And if you really think about that, you really have to make the move now if you're planning on buying and staying for at least 5 years. There has never been a 10-year period in history where prices are lower 10 years later than they were at the beginning of that 10-year period. And those cycles are getting smaller. So I think that as long as you have a reasonable expectation to be staying in this home for at least 5 years, now is a beautiful time to make that purchase. because you're not in competition with a bunch of other people. You can get credits for closing costs. You can do what's called a temporary buy down, and you can actually lower your interest rate for the first 1, 2, or 3 years using seller credits to lower your interest rate and lower your payments until we see the shift back to lower interest rates once we get out of this high inflationary environment. So hope that helps a lot. If you have any questions, please give me a call. If you're thinking about getting qualified to purchase a home, I would love to help you out, and I hope you have an absolute wonderful weekend. We'll talk to you soon.